And I would say absolutely. Now, one of the commentators on Yahoo's tech ticker pointed out or mentioned today that he doesn't believe that Hungary will be as bad off as Greece because they don't have the euro, and the euro put Greece in a very bad position because they couldn't print their own money, and so they needed a bailout or they needed to cut their programs and have all this rioting going on in the streets. Whereas Hungary is like the United States, and it can just print money out of thin air, devalue its currency, and then just move on. Well, that certainly is an option, but it's not a good option. I mean, there's a lot of bad things that arise from a country printing money. For starters, anyone who has money, namely the citizens of that country, are now getting devalued currency. So if you just had money in a retirement fund, or you have money in a savings account, if you have money that you have in bonds, like where you're planning to get paid back, all that money is going to be devalued. And so you're not going to get paid back in the same value of currency that you would have been paid back before. Now, we're not talking about a little bit of inflation in the case of Hungary. We're talking massive inflation. If a country defaults, you're going to lose a major part of your purchasing power. I mean, imagine you saved $100,000 in the bank, and all of a sudden overnight or over the course of a year it's worth $20,000. Well, you'd be in terms of what you could actually purchase. Now that's sort of what people in Hungary are going to be experiencing if the government starts printing its money. Whereas in Greece didn't have that problem because people were generally just broke in Greece, so they didn't have any money. But if you had any money in Greece, you didn't really have to worry because you weren't going to have to worry about the government printing the money and devaluing what money you did have. So Hungary is actually citizens of Hungary are actually in a much worse situation than the citizens in Greece. And the country itself is prone to having a lot more problems down the road because when countries print money, it doesn't really instill any discipline in the country. Like, for example, with Greece, a lot of what the riots were about were the fact that the government had to cut programs. It had to force spending cuts. It had to make sure that inefficient areas were cut. Wasteful programs had to be cut. Even programs that maybe weren't so wasteful but that just weren't efficient enough had to be cut. And that stuff is not going to go on in a country where it can just print the money and try to spend it and stimulate back into the economy like Hungary or the United States. And so countries like the United States and Hungary perpetuate their problems and debase their currencies. So it just makes it that much worse. So the big question now is for the United States, at least in the immediate term, is how much exposure do banks in the United States actually have to Hungarian sovereign debt? Now, obviously, Hungary is a much smaller nation than Greece, and certainly than other countries such as China or the United States. But it is still a large economy. It's a whole country, and so by virtue of the fact that this country is going to potentially go belly up in terms of needing to default. It's going to put a lot of pressure on any banks in the United States that lent money to Hungary. So if banks start finding out that they're going to get paid back in depreciated Hungarian dollars, they're going to have to write those losses off on their books. And that's going to put even more pressure on our government to then bail out those banks and then initiate another stimulus and bring us down even farther down the road to serfdom. Well, I think that's all for today, and I hope you have a great weekend.